Welcome to the accounting class. This is our second session on corporations. So let's get started right away. This session is about stock. Stock represents a share in the ownership of a business. Certificates for stock are held by stockholders. You need to start a corporation before you can issue stock. This is done by obtaining a charter for the corporation, which you can do in any state. It does not necessarily have to be the one that you live in. Then you need to write the rules of the corporation. We can now get a license to trade from the state. You will need a license from every state where you plan to register to do business. That is, you need a license to trade. Now we have our charter, our rules, and our license. So let's raise some capital by selling some stock. Most frequent stock offered for sale at the start is common stock. What does common stock mean? Well, the rules of the corporation will explain what the entitlements are for the owners of common stock. Typically, shareholders can expect a number of benefits. Stockholders are entitled to vote at meetings. Their first votes will be to elect members of a board, that is, the board of directors. They will also be entitled to vote on any motions put forward to the board. If the company has net income, they may get a dividend. What do we mean by they may get a dividend? Well, it's not a certainty. It is up to the elected board members to determine whether there will be a dividend or not. Now, what happens if the corporation goes bankrupt? The stockholders may get a share of money realised from sale of assets, but the creditors have got to be paid off first. And of course, our stockholders will get a certificate. Yes, a nice brand new certificate. These certificates have to show certain pieces of information. If you are a stockholder, then your name must be on the certificate, and so must the name of the corporation. The certificate must record the number of shares that you own, it will be numbered, and it will bear the signature of an authorised officer. So how does our corporation go about selling stock? If we are a private corporation, we can decide to whom stock will be sold. If we are a large public corporation, we will sell the stock through an exchange. The largest exchange for this in the USA is the New York Stock Exchange. The stock may first be sold at par value. Par value? Par value is the initial value that is assigned to the stock for sale. If we do not assign a value, then it is non-par stock. There, that's pretty straightforward. Does par have any special meaning? Yes, it does. It represents a legal value per share that has to be retained in the business. Now let's get around to some of the accounting. How do we make our entries for the stock we are selling? The two accounts used are cash and common stock. Cash is an asset account and is debited with the money received from the sale of stock. Common stock is an equity account and is credited with the par value of the stock sold. It is possible that stock can be sold at more than par value. When this happens, the double entry is slightly different. The amount of cash received must still be recorded as a debit to the cash account, only the par value is recorded as sale of common stock. The amount that was received in excess of par value is recorded in a separate account. How will this be shown on the balance sheet? Under the heading for stockholders' equity, there will be a separation of common stock and the amount paid in as capital in excess of common stock. What about this term treasury stock? What does this mean? This term is used when a corporation buys back its own stock. The stock is said to be held in the corporation's treasury. Why should a corporation want to do this? If the number of publicly held shares has been reduced, then the corporation can report a higher figure for the earnings per share. The corporation may also want to reward certain employees with shares as a bonus. Holding shares like this can help when trying to acquire other companies. Buying shares may also help raise the price of stock. The message is meant to be that the corporation thinks that its stock is undervalued on the market. Treasury stock is actually a common feature of many public corporations. Over 50% in the USA have treasury stock. How does this affect the double entries? The cash account is credited with the amount paid for the stock. A treasury account is debited with the value of the stock held. The amount is the amount paid for the stock. This amount is deducted from total paid in capital when showing stockholders' equity. What about preferred stock? What are the advantages of this stock? The term indicates that it has certain preferences over common stock. If the corporation goes bankrupt, then the preference stockholders get first call on what is left after liquidation. The creditors must have been paid off first, of course. They also get preference for any dividends declared. The downside is that they will not get voting rights. Issuing preferred stock can be a way of raising money for a corporation. On the balance sheet, you would find the preferred stock listed before the common stock. This is the end of the second session on corporations. Thank you for watching and listening. For further information about accounting videos, please contact the Walking Brit at the address shown.